Hi guys, welcome back to Big K Crypto. Today we're going to be talking about the topic of the week, which is the Bitcoin halvening. We're going to be talking about what it is, how will it affect the price, and what does it mean for miners and Bitcoin's long-term prospects. Before we get started, if you want to know how to grow your crypto portfolio, understand the crypto space, and all other crypto and passive income related stuff, start right now by subscribing and hitting the bell. So you might have heard that we've just hit the latest milestone for Bitcoin, which is the halvening. Of course, the halvening, to a lot of people that are new to the space or just don't understand the technical sides of Bitcoin, kind of hear it as, I don't know, the title of like a horror film or something like that. But actually it's the nickname of one of the most hotly anticipated events in Bitcoin's history. On the 11th of May, the number of Bitcoins entering circulation every 10 minutes, which are known as block rewards, will drop by half to 6.25 BTC from 12.5. It's a milestone that's easy to see coming because we know it happens every 4 years, and it's happened twice before. So after every 210,000 blocks or so, Bitcoin goes through a process called halving. This mechanism was integrated into the protocol by Satoshi Nakamoto himself. After a protocol goes through the halving, it cuts the supply of new Bitcoins in half, halving the miners' block production rewards as well. So what is the Bitcoin halving? Specifically, the Bitcoin protocol cuts the Bitcoin block reward in half. Every time a Bitcoin halving occurs, miners begin receiving 50% fewer BTC for verifying transactions. As you should already know, especially if you've seen my Bitcoin for Beginners series, Bitcoin does have a 21 million upper cap. In other words, there will only be 21 million Bitcoins that will ever exist. So why does Bitcoin have an upper cap in the first place? Well, for one, fiat currency is extremely inflationary in nature. Let's take the Federal Reserve, for example, which controls the US dollar. Anytime they want to regulate the supply, they can, by simply injecting more cash into the system. Many people see this as highly unethical practice. This is why Nakamoto hard copied an upper cap to make sure that nobody can randomly inflate Bitcoin supply as they see fit. Number two, some way was needed to distribute the currency. Miners will initially use their computational power to distribute Bitcoin. After all the coins have been mined, transaction fees could take over to secure Bitcoin's tokenomics. So having a 21 million cap ensures that Bitcoin is a deflationary asset as opposed to an inflationary one. At the very core of Bitcoin lies the concept of mining. I'm pretty sure that you've probably heard the term by now from my other videos, and you may even be familiar with what it means in the context of Bitcoin. If you haven't, please make sure you click the video that I've linked in the top right hand corner of your screen, as well as in the description below, what is mining in my Bitcoin basic series. For those who don't know, mining is a process from which certain nodes, called miners, use specialized mining equipment to solve cryptographically hard puzzles. When you send a transaction in Bitcoin, it gets queued up in a place called the mempool. The miners pick up these transactions from the mempool and form their block. If the block fulfills the minimum requirements, then it will get added to the Bitcoin blockchain. You must keep in mind though that mining happens to be extremely resource intensive. It costs a lot of electricity and money to mine Bitcoins. The block reward is supposed to economically incentivize the miners to participate in the mining process. If there's no stopping mechanism, then the miners could theoretically just, mine away all the Bitcoins in the world, completely skewing the overall supply-demand equation. So, speaking of supply and demand, let's just go into a quick brief lesson to some of you that don't understand, the basics of economics 101. One of the most basic principles in microeconomics happens to be supply and demand. This is going back to my uni school days. But let's just kind of cover the basic topic first. So as you can see here in the picture, the supply-demand equation states that given all else is equal in a competitive market, the price of a particular product will vary until it reaches economic equilibrium, wherein the quantity demanded is equal to the quantity supplied. No, that didn't just roll off the tongue. I did read it. Yes, fuck you, man. I'm cheating. So what? Sue me. So this leads us to two situations. The supply is high and the demand is low, which leads to a decrease in the price of an asset or product. Or the supply is low and the demand is high, which leads to an increase in the price of the asset or product. So if the miners were allowed to indiscriminately mine Bitcoins, it would exponentially increase its circulating supply, crashing its price in the process. This is why the Bitcoin halving mechanism was hard-coded into the protocol to monitor the circulating supply. So Here's a brief overview of the Bitcoin halving schedule. 2009, Bitcoin mining rewards started at 50 BTC per block. In November 2012, the first Bitcoin halving takes place to reduce mining rewards to 25 BTC. Middle of 2016, the second halving takes mining reward down to 12.5 BTC. And of course, this week, the third halving happened and it saw the reward fall to 6.25 BTC. After the last Bitcoin does get mined, the miners will rely entirely on transaction fees as a means of revenue instead of the block reward. However, while transaction fees are minuscule, obviously, compared to the block rewards themselves, between December and January 2017/18, at one point, I think the average transaction fee was around $54. The reason why this happens is very simple. Let's consider this scenario, going back to the Economics 101 chart. When the demand goes up, the number of transactions getting queued up in Bitcoin's mempool spikes as well. However, Bitcoin blocks are limited by 1 megabyte size, so there are only so many transactions that can be committed to each block. To circumvent this, the senders can increase their transaction fees to incentivize the miners to give them preferential treatment. So around 2140, we can expect Bitcoin's demand to go up due to the following reasons. So, number one, no new coins. Firstly, since there will be no more new coins injecting itself into the market, this should fundamentally appreciate Bitcoin's value, increasing its overall demand. This is why the value of the transaction fees should spike as well. 2. Use cases. It won't be a stretch to imagine that around 2140, the number of use cases for Bitcoins should increase quite a bit. As the number of use cases increases, the transaction volume should increase as well. So of course this will in turn, in theory, lead to an increase in transaction fees as well. So what happens when Bitcoin halves? Let's look at the first point, mining stability. The first point to look into while judging the impact of halving is the mining stability of the system. As we've already stated, miners play a crucial role in Bitcoin's ecosystem. Along with mining new blocks and aiding transactions, miners are also responsible for the overall network upkeep. This is where we need to talk about the hash rate. So brace yourself guys, it's going to get a little bit more technical than usual. Hash rate is the term used to describe the computational ability of a network. The higher the hash rate, the more speed and security of the network. If miners suddenly decide to leave the network, then the following may happen. The network will get clogged up because the transactions will not be processed as no one will be mining any blocks. Or a powerful mining cartel can use its superior hash rate to take over Bitcoin's network via a 51% attack. So keep all this in mind when you consider that miners depend on block rewards as a major source of income. How do they deal with halving events? Do they just leave the network to cut their losses, or do they soldier on for the good of the network? So that brings us to the question, how can Bitcoin miners stay profitable? Well, there's a lot of steps that miners can take to remain profitable. They could opt for energy efficient hardware such as the Dragon Mint T16 and the Antminer S9. These ASICs provide high processing power with lower power consumption. Or miners can move their mining operations to regions with cold weather and cheap electricity. Colder areas will allow miners to cut energy consumption from cooling systems dramatically. Certain mining companies have moved to places like Ulaanbaatar, Mongolia, and Bratsk in Russia, where the weather is cold and the electricity is cheap. Also, miners can also opt for alternative sources of electricity to help power their operations. Finally, the big question that everyone's asking, does Bitcoin's price actually increase after it goes through a halving event? After the 2012 halving, the price of BTC to USD rose briefly from $11 to $12 before catapulting to over $1,000 in just 1 year. That's over a 9,000% increase in price. Then, 210,000 blocks later in July 2016, Bitcoin went through another price surge. Bitcoin went up from $576 to $650 as buyers started accumulating Bitcoin in anticipation of the halving. The price then picked up the pace and went up to $2,526 precisely a year later on July the 9th, 2017. That's a 288% increase in valuation. Here's a quick overview of the effects of the 2012 and 2016 halving events. So in 2012, before the halving, we had 50 BTC per block, and of course after the halving, we had 25 BTC rewards per block. Price on the halving day was $12.35. Price after 150 days was $127. If we look at 2016, the reward was 25 BTC per block, and then of course after the halving was 12.5 BTC per block. The price on halving day was $650, and the price after 150 days was $758. So while Bitcoin did see an increase in price post the 2016 halving, it was not as substantial as the 2012 halving. According to experts, this happened because everyone in the community was highly anticipating the halving, so any expected price action was already factored in. This is why it won't be surprising if Bitcoin's price action post the 2020 halving event isn't that surprising. So let's look at the other side of the equation. What are the arguments against the halving event affecting Bitcoin's price? Bitcoin's current situation is a lot different from 2016 and 2012. There are specific issues that we need to consider to understand why the halving may not affect Bitcoin's price that much. Could be miners are selling off their block rewards instead of holding onto it when the market is up. It could also be Bitcoin now has futures trading. Since futures trading doesn't actually require actual Bitcoin to do the trading, this makes the volume of BTC mined a lot less important. And finally, it could also be the amount of mined Bitcoin volume is minuscule compared to the total volume traded. Back in 2012 and 2016, the ratio wasn't that skewed. However, nowadays, millions of Bitcoins are trading daily. So even if the block reward reduces from 12.5 to 6.25, it won't make much of a difference. With the presence of institutions in the marketplace, the trading volume of Bitcoin is higher than ever before. So, to conclude, Bitcoin halving is at the very core of the protocol. Think about it. Halving ensures that it retains its deflationary quality. This makes sure that it remains ideologically opposite to fiat currency, which is centrally controlled and inflationary by nature. Satoshi Nakamoto had ensured that even after all the Bitcoins had been mined out, the internal tokenomics will sustain the network. It's still too early to tell if Bitcoin will actually follow its historical precedent and increase its valuation, or will the new factors hold it down. Now, just to summarize, guys, everything that we just discussed today is purely just facts that have happened up to now. I'm not going to give my thoughts as to what is going to happen with Bitcoin over the next year, or 2 years, or 3 years. As you all know, I make the majority of my passive income and my crypto income from trading. So to be honest, I couldn't really care if it goes up or down. I don't hold on to Bitcoin long term, so none of this really affects me per se. But it is interesting to get the facts out there, and I did really want to explain the halving in more detail, just because it's been such a big event over this past week, the anticipation of the event, and of course now the disappointment of the event that I believe is going to follow. So I hope you've all enjoyed it, guys. If you haven't done so already, please subscribe and like this video, and I'll see you on the next one. Cheers.